This is Barry Norman on behalf of ETX, and welcome to our class on Bollinger Bands. Now tonight we're going to be discovering one of the world's leading trading indicators developed in the 1980s by John Bollinger. Now Bollinger Bands has become so popular that there are many different types of trading strategies using Bollinger Bands. And we have a second class called Strategies using Bollinger Bands. But before you can apply any strategy, you have to learn what a Bollinger Band is, how to put it on your charts, and how to read it. So tonight we're going to be going through all of these steps so that you are an expert on Bollinger Bands. Now tonight's class is sponsored by ETX Capital, and we're here from ETX. And since those of you that are been regulars in our webinars, or those of you who haven't joined before, ETX is a regulated provider, and therefore I'm required to give you a risk warning. So let me read that and get it out of the way. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risks. All information is provided in this webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors, and we do not recommend any securities or instruments of any kind. Any securities or instruments that are mentioned throughout are cited only for illustrative and educational purposes. Now, for those of you that aren't that familiar with this, ETX is a fast-growing financial services company based in London. We are authorized and regulated by the Financial Conduct Authority, the FCA, and up until recently, binary options were not a regulated product, although our CFD, our spread betting, and our Forex trading is. But since we are a regulated provider, starting in January of 2018, binary options will also fall under the FCA, so they'll be fully regulated. We are also a member firm of the London Stock Exchange under our parent, Monaco London, and we also have a global client base. When you trade with ETX, you can trade using our ETX binary platform, and if you're new to the markets, it's a great way to trade because all your risk is the amount you type into the screen, and you're simply deciding whether an asset will go up or down. But it's the same price as the assets on Forex or CFD or commodities, and therefore you can learn and figure out and get a good hand on the markets without having risk. But once you can master the markets, you need to understand risk and how to protect yourself in the time of trading and how to use risk management strategies. And once you have this down pat and you're ready to take the risk, you can go over to our ETX Pro platform, which is our internet-based program, which will allow you to trade directly from any computer just simply using a login. You'll get the lowest possible spreads. You'll get incredible order entries and stop losses, and you'll get fully customizable charts. You get a full array of tools and everything you need to trade from. Then, if you want the more professional platform, you can download our MT4 platform, which will allow you to add on all the expert advisors from around the globe. You also have some of the most accurate advanced charts, and you can also build your own automated trading system right in the MT4 platform. So whatever you choose, just contact customer support, and they'll get you set up with one of them, all of them. You can have as many as you like. So let's get started with binary options. Now, tonight's class is being recorded. If you wish to see a recorded version of this class afterwards, it takes about 24 hours to get up there, but you can just use the same link you used to come to tonight's class to see it again in a recorded format. Now, Bollinger Bands were created by legendary money manager and researcher John Bollinger. Bollinger Bands are one of the most popular indicators applied by traders throughout the world in nearly all markets. It's rare today to see a chart not accompanied by Bollinger Bands, as they become the most visual tool that allows traders to see how overbought and oversold a security is, as well as to see the swing of the market, the volatility of the market, and help you place stop losses and take profit points. There has been an abundance of information published on how to trade with Bollinger Bands. Much of it is through discretionary in theory, and how to use Bollinger Bands information usually pushes it back to the trader to interpret what a securities price is doing relevant to the bands. So before we describe the strategy, let's look at exactly what a Bollinger Band is and the genius of Bollinger Bands. Now, Bollinger Bands can be applied in all the financial markets, including equities, forex, commodities, and futures. It can also be applied in all time frames. It is more responsive in daily or hourly time frames. When you go down to 1 minute, 5 minute, 10 minute, 15-minute charts, Bollinger Bands is not that responsive. So, Bollinger Bands answer a question: how high or low are prices on a relative value? By definition, price is high at the upper band and price is low at the lower band. That bit of information is incredibly valuable. It is even more powerful combined with other tools, such as other indicators for confirmation. So Bollinger Bands are a technical analysis tool. Specifically, they are a type of trading band or envelope. Trading bands or envelopes serve the same purpose. They provide relative definition of high and low that can be used to create a rigorous trading approach in patterns, in pattern recognition, and for much more. Bands are usually thought of as employing a measure of central tendency as a base, such as a moving average, whereas an envelope encompasses the price structure without clearly defining the central focus. That's a lot of words. It doesn't mean a lot to any of us, does it? So let's go over and talk about what you see on a chart. Okay, and let's put these on a real live chart so you know how to do them step by step. So Bollinger Bands are used to measure highness and lowest of price relative to the previous trade. Bollinger Bands consist of an upper band at 1 times a 5-period standard deviation and a 5 lower band at a 1 times 5 standard deviation below the moving average. The closer security is to its lower level, the more it's oversold, and the closer security is to its upper level, the more it's overbought. Okay, so keep that in mind, and let me pop up some charts on our screen. Okay, and let's change this to the Euro US dollar. Actually, we'll leave it here on Bitcoin. Everybody's talking about Bitcoin these days. Now remember, I am not giving you any trading advice. We are not looking at Bitcoin at the moment to make a decision as to whether you should buy or sell Bitcoin. We are only here at this chart tonight to look at how to put Bollinger Bands on a chart. So let me take off the Bollinger Band. Now what we're looking at is a simple Japanese candlestick chart and volume down below. But we don't need volume at the moment, so we'll get rid of volume. So we're looking at a simple chart. We're looking at a 1-day chart for Bitcoin. Now you have to decide what time frame you want to use your chart for. I'm a 30-minute trader. I like charts on a 30-minute time frame because I'm a short-term trader, but I usually trade something within a day's period. So we can look at it in 30 minutes, we can look at it in 1 hour. Whatever you're looking at is the chart you'll use to put Bollinger Bands. Bollinger Bands uses the open, the high, the low, and the close for whatever time frame you're using. So it is self-adjusting. So let's go back to the 1 day. And we have a 1-day Bitcoin chart. Because Bollinger Bands is so popular, because Bollinger Bands is so popular that any charting service offers them and they will drop them on your chart automatically. But that being said means you're putting something on your charts that you have no understanding about. So we're going to go up here to charts and we're going to go down to indicators. We're going to locate Bollinger Band and we're going to click on it and put it on our charts. Now, what we have is 3 lines that we can see on the charts. We have an upper band, a lower band, and we have a moving average. The area between the upper band and the lower band is highlighted in a lighter color. This is considered the Bollinger Band. It's the band. The width of this band actually shows us the volatility in the markets. The shape of the band doesn't tell us anything. You'll see all kinds of weird shapes. I've seen ones that look like space aliens. I've seen all kinds of weird things. The shape doesn't matter. Just the distance between the upper and the lower band show us volatility. So when we see a tight little narrow band, it's telling us the markets have very little volatility. When we see wide bursts in the band, it's telling us the markets are quite volatile at the time. So let's figure out what all this is that we're looking at. So I'm going to go up here to the indicator, and every chart service, no matter which one you use, will give you a way to set your settings. So I'm going to go up here, and so we can see that we have the upper line and the lower line and the basis. Okay, the basis is the moving average, and we have, of course, the background. So we're going to change the upper band in this one, just so you can see it better for class, to a bright blue. You can have these as whatever color you want. We're going to change the lower band to a bright purple. We're going to make them wider, and I'm only doing this so that you can see what I'm talking about. And so I've adjusted it, and we're going to take the background, and we're going to make it a light gold. Then we have the basis band. To me, that is the moving average band, and we'll make that one bright red for just this class. Now, we have the three bands, but we also have to see what the input, what the mathematics are using, what the calculations are using. So we go back up here and we can click on the input. So we're seeing right now that we have a 2 and 20 standard deviation. This is the standard deviation that was developed by John Bollinger. Okay. It's a long roundabout calculation. Standard deviation is a mathematics formula, not for the financial market. It's just a mathematics formula that no person in the right mind will ever do by hand. It's always done by a computer. But it is a deviation based on volume and volatility between the prices. And it uses a length of 20. So we're using a standard deviation of what's called a 220 standard deviation. And that's what we should be using for Bollinger Bands. Now, we can use Bollinger Bands with candlesticks, with line charts, or with bar charts. Doesn't make a difference because it's the relationship between the band and the price and also the width of the bands. And it is said that all the price movement that happens in the whole story can be told within the bands of the Bollinger Band. So we have the upper line, the lower line, which we have in blue and violet. And we have the band here in the light gold, and we have the moving average band, okay, right here on the center. All the moving average band does is, what does moving averages do? Moving averages take the volatility and the noise out of the markets. Ladies and gentlemen, I'm going to ask you something because my system popped up and tell me there's a problem with the sound, or asked me to do a sound check. Can you guys just write in and let me know if you can hear me all right? Okay, I'm sending you a message. You can just type back because I just want to make sure you're all hearing everything just fine. Great, thanks. Sometimes, now the sound check just moved back to perfect. Okay, thanks. Okay. So now we have the Bollinger Band on the chart. We don't know what to do with it yet, but we've learned how to put it on the chart. It wasn't so complicated, was it? So let's go back over to the boring part and let's learn a little bit more about text. In the meantime, I'm going to show you a charting system for the same Bitcoin in a 1-hour chart using Bollinger Bands. Now, Bollinger Bands are always used in combination with other indicators. But like I said before, basically all the story of the price movement can be found within these two bands. And look at this, as the price of Bitcoin is getting more and more steady, less and less volatility, see how the bands are contracting. No, we're not talking about an uptrend, because even though we have the price in an uptrend at this point, okay, the bands are staying pretty even in their width. So that's telling you nothing, because Bollinger Bands are not about trends. They're about volatility. Volatility is how much the price is moving in either direction. Now, when the price breaks out of a band, it can tell you something, because the bands also work as support and resistance levels. But again, you have to use them in combinations of with other indicators. I can't get my marker shut off here. Give me a second. Okay, so interesting, in the real world, no statistician would ever calculate standard deviation by hand. The calculations involved are somewhat complex, and the risk of making a mistake is high. So calculating by hand is slow, very slow. This is why statisticians rely on spreadsheets and computers to crunch their numbers for standard deviation. And like I said, in this case, we're using a 220 standard deviation, and we'll let the computer systems do the calculations. But that gives us the upper and the lower band. So as the name implies, Bollinger Bands are price channel bands that are plotted above and below the price. The outer Bollinger Bands are based on price volatility, which means that they expand when price fluctuates and trends strongly, and the bands contract during sideways consolidation and low momentum moves. So by default, the Bollinger Bands are set at a 2 standard deviation. Now, I put this in and I keep meaning to take it out and I forgot. However, we suggest setting the Bollinger Bands to a 2.5 standard deviation to make them wider and capture more price action. Okay. You can skew the bands by adjusting the standard deviation. But if you don't know what you're doing, you'll make yourself some serious problems. But if you're using bands as a beginner, by putting it up to 2.5 standard deviation, what that means is much more stuff will stay within your bands so that you won't get signals when the price breaks out. Okay. And so when price does break out, you get a lot more meaningful signal. But remember, whenever you move from the standard that John Bollinger wrote for you and did all the back testing and everything else, you're now coming up with something that doesn't fit the formulas. Okay. Now, what we're looking for is price to start moving along the band. And this is called riding the bands. Okay. You can ride a band up or down. Okay. Bollinger Bands contract during slow-moving markets, and the outer band presses out during fast-paced moving markets. So remember, the calculation for standard deviation is a measure, and I'm going to give it to you flat, okay? And then we're going to move on for standard deviation, because I still don't, myself, after all these years, even actually understand it. Standard deviation is a measure of the dispersion of a set of data from its mean, which is the average. It is calculated by the square root of variance by determining the variation between each data point relative to the mean. If the data points are further from the mean, there is a higher deviation within the data set. The mean being the center point or the moving average. What all that means, I don't know. I'm not a scientist. I'm not a mathematician. It doesn't mean anything to me. It just means to me that it's an accepted formula. In finance, standard deviation is a statistical measurement. When applied to the annual rate of return on investment, it sheds light on the historic volatility of that investment. Okay. In its simplest form, the mean is simply the average of all the data points in the given set. In investing, for example, you might want to know the mean closing price for the last 20 days. This can be obtained by adding the closing price for each session and dividing by 20. But to me, that's just an average. Because markets are fickle at best, traders and analysts use moving averages that adjust daily to incorporate most of the data. This means the calculation is always taking into account the most recent session's movement, and older sessions drop off as they become less relevant. An exponential moving average is calculated by weighting each data point, giving greater significance to each data. Standard deviation is calculated based on the mean, and the distance each data point from the mean is squared, summed, and averaged to find its variation. So instead of taking a moving average and dividing them all and then subtracting by 20, it squares it, sums it, and then averages it. Okay? I don't know, but it works. That's all I have to know, is that it works, and it's a proven calculation. Now we come to an interesting part. Percentage bands are fixed. They do not adapt to changing market conditions. Bollinger Bands use standard deviation to adapt to changing market conditions. So what do we have? We have the middle band is usually 20 base. That's the moving average in the center. The upper band spread above the moving average by a volatility known as standard deviation, set at a 2 standard deviation. The lower band, the middle band less the same lower band, is the middle less the same volatility. So in other words, we come up with the 20-day moving average for the center, and then we add a 2-time standard deviation to make the top band, and then we subtract from that same moving average line a 2-time standard deviation to come to the bottom band. So the two bands are equidistant from the moving average line. So let's translate that. Now, once we have these lines on the chart, okay, and we're past that, we've now got the lines on the chart. We have the Bollinger Band built on our chart. Because you know what? We didn't have to do all those calculations. We clicked the little button and put the Bollinger Bands on our chart. We know there are 220 standard deviation. We know we have the 20-period moving average line in the center. We know that the width between the bands shows volatility. We show that all the price action should appear in the center of the band. Okay. We got that. We got that with a push of a button. Now, there are 3 primary uses for that information once you have it on your chart. And Bollinger Bands is one of the few technical indicators that's actually dropped over top of your price on the price charts. So let's go back and look at these charts again for a second. So as you can see, we dropped the Bollinger Bands right on the chart. Again, we didn't do anything. We went up here to indicators, clicked on Bollinger Bands, and everything was set on the charts for us. But you notice it goes right over the price movement. When we come over to this other chart, okay, we can see that all the other indicators are dropped below. On price charts are usually very few things. You have Bollinger Bands. It's one of the few technical indicators that drop right over top of the charts. Of course, you have moving averages that you can put on your chart directly. You have trend lines that are put on your chart directly. You have Fibonacci numbers that are drawn across your chart, but they're not over top of the price. And you have support and resistance lines that are drawn through the price. Everything else is put below. So like below, you see MACD, you see RSI, you see DMI, stochastics, all fall below your charts. Whether you want to use it with candlesticks or bar charts is completely up to you, depending on the type of trading you do and the type of charts you use. So we use this indicator to give us 3 basic types of information. We can first have pattern recognition. And pattern recognition is one of the most important things you can do on a chart. You know, we've had classes where we talked about pennants and flags. We've talked about double tops and double bottoms. We've talked about channels. We've talked about wedges. We've talked about teacups. Okay. Bollinger Bands will help you recognize double tops, head and shoulders, and double bottoms very easily. It'll also help you see reversal signals, identifying early warning signals, signs of a reverse, and it will help in trend analysis, detecting trend continuation or conclusion. So there are some that are simple, very easy strategies, and there are some that are more complicated. But before we go look at my favorite, which is %B, let's look at some easy interpretations for you to take the first bite of using Bollinger Bands. So we talked about chart patterns. One of the most valid and oldest ways of using charts was to locate movements or price movements in the price action that form specific patterns that we could see over time, repeated often. So when we see these, whenever we see these patterns develop, it can predict or help us understand the market psychology and where a price should be going. Now with Bollinger Bands, we refer to them as M's and W's, or simply they can be double tops and double bottoms. But they form within the band or on the band, and you can see on this band, you can see a beautiful W. Price moving down, up, down, up. What is that? We call it a W, or we can call it a double bottom. We have the reverse of that, which is called an M, which is a double top. Now, typically viewed as a strong reversal signal, I'm sorry, my marker won't get up. Typically viewed as a strong reversal signal, a double bottom and double tops. The Bollinger Bands can be useful in identifying potential entry points for trades and even breakout opportunities. Do you notice when we see the band riding down for the first bottom here? We wouldn't see a double bottom here. We wouldn't see anything at that point. We see the band bounce back up. We see it come back down to an equal level of where it was with the prior swing low. And it starts moving back up. So we're forming what? A double bottom. It's telling us this downtrend has ended at this bottom and we should move into a very strong uptrend. So a bullish bottom pattern is formed by two successful bottoms in price action, which typically resembles a W. Although at first it will resemble an upside down N. The key lies in establishing bullish positions near the lower Bollinger Band with a target set for the upper Bollinger Band. However, if price continues to fall, it may be a strong sign to exit and search for a new opportunity. So when we saw in this chart, bottom, came back up, formed the center for the W, came back down to form the second bottom, which is about equal to the swing low of the previous bottom, and moved back up. If it did not bounce off of this bottom and carry it back up and start moving down, that tells us it's a very bearish signal. Here, when it moves up and continues upward, it's giving us a bullish signal. Same as reverse when we get a M formation. So a bearish top is formed by two successive tops in price, which, as opposite to the W, form the M. Before forming the entire M, an N will emerge in the price action, and this point is where traders should want to get involved. So what you're looking for is that N formation to continue out into the M or the W. You can have an M upside down or right side up. When the second peak and the M has been formed by the asset price action, it is time to establish a bearish position in a trading asset. Should price continue to rise after the fact and move higher above the second top, it is a signal to exit and wait for new opportunities. We highly recommend combining the Bollinger Band with the RSI indicator, as it's a perfect match. There are two types of tops that you need to know about. After a trend move, prices fail to reach the outer band as the uptrend becomes weaker. This signal is usually accompanied by an RSI divergence continuation signal. During consolidation, price spikes to the outer band of Bollinger Bands, which gets rejected immediately, and reversal a short signal. The screenshot, which I'm sorry is too small to really see, shows us the first market type of the divergence. During trends, the moving average holds very accurately, and the break above that moving average is usually a meaningful signal that the sentiment is shifted. The screenshot we're going to look at in a second below shows nicely how price trended between the outer band and the moving average, both up and down. So here we can see that we have the wide bands and we have price breaking the moving average, which is the yellow band in this case. Then it's riding up the moving average, and guess what? Broke that moving average again and moved into a downtrend. So this is the Bollinger Bands 20-period moving average, but you have to look at this in conjunction. Are the prices maintaining inside of the band? Okay. Are they riding the band? And we can see this beautiful ride up here on the band. We don't have any high volatility, we have steady volatility. We have the break of the 20-day, and this is signaling an end of that trend. So you can use this very well interpreting the price movement very easily with the moving average and the width of the bands. While Bollinger Bands are exceptionally helpful in determining when an asset has overshot the upside or the downside, it is important to use the bands also to set risk conditions, not just entry points. Additionally, risk and reward should be set based on the width of the bands or volatility, with narrower risk rewards during low volatility and wider risk reward ratios during higher volatility. In contrast to most other indicators, Bollinger Bands are non-static indicators, and they change their shape based on recent price action and accurately measure momentum and volatility. Thus, we can use Bollinger Bands to analyze the strength of a trend and to get a lot more information this way. We want to pay attention to a couple things. There are just a few things that you should look at. During strong trends, price stays close to the outer band. If price pulls away from the outer band as the trend continues, it shows fading momentum. Repeated pushes into the outer band that don't actually reach the outer band show a lack of power. A break above the moving average is often the signal that the trend is ending. The screenshot shows how much information a trader can pull from using Bollinger Bands. So let's walk through 1 through 5. Now, it's hard for me to walk through, keep the chart on the screen and go through, so we're going to come back and forth. But if you notice, keep in mind, here we have 1. The band broke the moving average and started moving down and worked and rode that band. Down here, it pushed down but could not come down to the moving average, and it bounced back up to form 2. Here, we have a double top. Okay. The band bounced back up and went to a moving average. And then 5, it moved back up and came back down. So let's talk about all the information step by step that we just saw here. So in 1, price is a strong downtrend, gives a signal in a strong downtrend. Price stays close to the outer band all the time. So it's a very bearish signal. Price fails to reach the outer band in 2 and then shoots up very strongly, even showing an engulfing pattern. This is a classic reversing pattern where the bearish trend strength has faded. So again, 1 coming down. It rode the band. That's a whole bearish signal. So we could have traded that asset coming down. It's giving us an entry point and a direction of the trend. Down at 2, when it couldn't reach that band again down at the bottom, it gave us an engulfing signal and told us that trend was reversing. It moved up towards 3. So let's go see what the actual definition of 3 is. 3 swings high. 3 is swing highs with lower highs. The first swing high reached the outer band, whereas the following 2 failed, fading strength. So what we saw was pushed up to the band, touched the outer band, fell down, came back, could not make that outer band, fell back again, could not make that upper band again. That's telling us that uptrend is definitely over and moved to a downtrend, which is gave us number 4. Then number 4, a downtrend where price stayed close to the outer band. It pulled away, but bears were fully in control. Then 5 is this price consolidates sideways, not reaching the outer band anymore, and the rejection of the pin bar ended the downtrend. So as you can see, Bollinger Bands alone can provide a lot of information about the trend and the trend. So in 4, we saw this, it rode the band all the way down. 5, it moved into consolidation action. You see the price isn't coming anywhere near that lower band. It's not able to break through. All of a sudden, it hits the upper band, bounces off it, and then moves into a downtrend. It also broke below the moving average. So we were able to get all of that story out of the Bollinger Bands. So John Bollinger then created, when the Forex market and the CFD market started to grow, he had to adjust Bollinger Bands to fit these new fast-pacing markets, because it was originally developed for the stock market. And this was readjusted directly by John Bollinger. And now the other thing is, Bollinger is one of the few places that you can go see his interpretation, not other people's interpretation, because he maintains a very big website. So you just go to look up www.bollingerbands.com, and you can see everything. And he's constantly updating, he's constantly putting strategy, all types of education, all types of learning, all types of interpretation. So you can actually learn from the mouth of the developer, not other people, and trying to tell you how to apply these things. Okay. So John Bollinger created the %B, an indicator that depicts where price was in relationship to the bands, and then added bandwidth to depict how wide the bands were as a function of the middle band. For many years, that was the state of art. Bollinger Bands, %B, and bandwidth. %B is an indicator of measuring the distance between the Bollinger Bands. Appropriately, this measure is called Bollinger Bands bandwidth. It's simply just a numeric value given to the width of the bands. So as that number gets bigger, we know the bandwidth is getting bigger. As the number gets smaller, we know the bands are contracting. It's just an easier thing to look at or listen to. Understandably, assets with higher prices tend to have higher Bollinger Band readings. In my opinion, the %B component of the Bollinger Band allows you as a trader to pinpoint proper entry and exit points when trading stocks, Forex, or commodities. Because by knowing, and see, we have the %B put on the calculation below. If we're using the width of the bands to make determinations, we're waiting for visual acuity, and you have to sit there and guess. If you're using the %B, which is the measure of the bands, you're actually seeing a numeric value that you can then very quickly tell whether it's a good or, if the bands are moving in which direction. %B is an indicator derived from Bollinger Bands and quantifies the securities price relative to the upper and the lower band. Okay, now here's the actual calculation. Okay, it's not complicated, it's just kind of, okay. %B equals 1 when the price is at the upper band. %B equals 0 when the price is at the lower band. %B above 1 when the price is above the low upper band. And %B is below 0 when the price is at the lower band. You're just plotting the ones, the zeros, and the 50% on the chart. And the percent B is above 0.50 when the price is above the middle band. And percent B is below. So you're only plotting 1s, 0s, and 5s. Okay. So let's not freak out. You don't have to do anything for calculations. Just go on to any charting service, go look for your percent B and click on it, and you can put it right on your charts. So you can see percent B on the bottom of your chart is the calculation of the movement of the Bollinger Bands. Ideally, when buying a security, you want the percent B reading to be below 0.1 for multiple days. The lower the percent B reading and the more days or the more time frames in a row that below that reading, the more oversold the security is. This is the key to trading with Bollinger Bands, and by applying a few additional filters, you are then able to build strategies with high averages of success. So successful day trading is mostly a game of pennies. The best firms and individual traders who day trade look to scalp a small amount using Bollinger Bands and percent B to show that intraday edge do exist. Now, the next class, which I don't know when is on the schedule, we're going to apply 5 different strategies of using Bollinger Bands to your everyday trading. So on that note, I'm going to say goodnight to everybody. I hope you're going to soak it all in. It's a lot to soak in. But once you have it down pat, this part's easy. You're putting it on the chart, you're seeing the width of the bands, you're seeing the moving average. Now we want to build it into your trading strategies, and watch for our class called Bollinger Band Strategies. And we'll talk about 5 different strategies to apply in your everyday trading. So thank you very much for joining us. We'll have a great weekend. Thank you for being part of ETX. And we'll talk to you again real soon. Have a good weekend now. Bye.